Hey folks, Mr. Olson here. Let's do some econ. We're in macro unit 2, which I call macro measures, also known as economic indicators. Welcome to macroeconomics. Today is our first lesson on macro. Before we jump into those indicators, let's talk about what macroeconomics is in general. So macro is the study of a large economy as a whole. So we are going to look at the big picture of how all the different economic pieces from microeconomics come together. So instead of looking at one consumer, we're going to analyze everyone. Instead of looking at one particular business, we're going to study all businesses together. Okay. And why the heck would we want to do this? What is the value of doing this? Well, one of the fun things about macro is it's a really new field. It's a new, relatively new subfield of economics. And it was born during the Great Depression, right? And a lot of what unfolded in the Great Depression in the 1930s, economists and the government did not understand why it happened, and they, more importantly, didn't understand how to fix it. So with 25% of people unemployed in the depressed economy, government didn't understand what to do. So macro is created in that context to, number one, measure the health of the economy. So how do we even get on the same page about coming up with indicators about how healthy the economy is? And then given our measurement of how healthy it is, how can we come up with policies to fix those problems? And we'll analyze those once we get to units 3 and 4, and we look at fiscal policy and monetary policy. So when we are measuring the health of the economy, which is really what this unit is all about, we're going to look at 3 things. Number one, we want to promote economic growth. If the whole economy is growing, the pie is getting bigger, and individuals have more goods and services available to them. So we want to measure and promote economic growth. We also want to limit unemployment. So we want to keep folks as work in their jobs as much as possible, earning income. And then finally, we want to keep prices stable, and that is through limiting something called inflation. So we're going to look at these 3 indicators, this unit, and we're going to talk about the kind of ranges that we want to keep them in for a nice, healthy economy. Today, we're talking about goal number 1 in terms of how do we promote economic growth, okay? And we need to talk about sort of the methods and the indicators we use for that. So there's this whole subfield of economics called national income accounting. Don't worry about it for our purposes, but there's a whole different world where economists collect statistics on production and income and investment. And so there's this whole field called national income accounting. For our purposes, we're mainly going to look at one of the indicators that comes up in national income accounting, and that is gross domestic product. So this definition is a mouthful. I don't like textbook definitions, but this is one term that we really got to kind of know the textbook definition and be able to break down all the different elements of it. So gross domestic product, or GDP, is the dollar value of all final goods and services produced within a country's borders within 1 year. Okay, let's break that down a little bit. GDP is measured in dollars, so it's not measured in apples and oranges and planes. It's measured in the dollar value of all the apples and oranges and planes and lawyer contracts, et cetera, within an economy. Okay, GDP measures the final goods, okay, and we'll talk about that a little bit later. So GDP is going to include the value of your new MacBook that you brought, but it's not going to include the value of the computer chips inside of it. Those are something called intermediate goods. So it's only final goods that are purchased for consumption. Okay, and it's also within a given year. So it's a annual economic performance. The big data usually comes out every quarter, but when we talk about GDP for comparisons purposes, we're looking at an annualized basis and comparing it year to year. All right. How do you use GDP? First thing we're going to use it for is comparing from year to year. So is there growth, right? What happened to the standard of living for individuals over the last 10 years, over the last year? Okay? And more specifically to that, we can compare policy outcomes. So the government passed this huge stimulus package to try to help economic growth. Did it actually work? How much did our GDP grow as a result of that policy? And then it also allows us to compare ourselves to other countries, right? So how does the GDP of the US compare to China or to Japan or to Luxembourg, and what's going on in those countries that may make them better or worse off? Okay. A couple fun data points to look at. I'm going to show you a slide in a second with the countries with the biggest GDP in the world as of 2020. So make a prediction about what you're going to see on the next slide. What are the top 4 or 5 largest economies in the world? Drum roll, please. The United States has the biggest economy in the world. So it goes US, then China, then Japan, then Germany, then the UK. So the US economy in 2020 was about $20 trillion. And we had the largest economy in the world. Okay. In terms of the smallest economies in the world, this is from the Wikipedia list. There are 192 countries. These are the bottom kind of set here. And you'll notice that a lot of them are small, least developed countries, and a lot of island nations are on there as well. Couple maps to show kind of fun with GDP. This is a world map showing GDP per capita, so GDP per person, which we'll talk about in a second, but it weights the size of the country based on GDP as opposed to square mileage. So you can see which areas of the world are ballooned and which areas of the world are shrunken in based on their GDPs. And then considering we live in the US with $20 trillion of GDP, this shows each US state and the country that is representative of the same size GDP, the same size economy. So California is about the same size as France, and so on and so forth. So those are kind of a couple fun indicators. When we use GDP to measure growth, you simply are going to look at percent changes. So if you want an equation for percent changes, you can use that there. Most students kind of do it intuitively, but if you want an equation, you take year 2 minus year 1 divided by year 1 and multiply it by 100, and that's going to give you the percent change. So if Mordor's GDP was 4,000 in 2015, and was 4,000 in 2014 and 5,000 in 2015, you need to be able to calculate what the percent change in GDP is, which would of course be 25%, an increase of 25%. Here's one more example. For Transylvania, the percentage change based on that scenario would be 5%. Okay, so you can plug into the equation if you want to, but you want to get comfortable looking at growth rates. Okay, and that's what we're going to be able to compare among fake countries on questions in this class, and more importantly, among real countries when you guys interpret the world. So I'm going to show you a chart here in a second that is the highest GDP growth rates in the world. As of the CIA fact book a few years ago, you may make a prediction about what would be there. Here's the answer. Okay, you could see a lot of times developing countries are going to grow at much faster growth rates than developed countries. We can talk about that a little bit later. And then here are some of the slowest growing countries in the world. In this case, these countries were shrinking in 2017. So they were moving down into recessions. Okay, so that's what overall GDP is. And the next question, though, is, well, what about standard of living? How does this tell us about the quality of life in a country? Well, of course, it's going to depend on the population. So that introduces the idea of GDP per capita, which is GDP per person. To get GDP per capita, all you do is you take the GDP, the total size of the economy, and you divide it up by the population. And that's going to identify the average person's economic opportunity and how many products each person makes. Okay, it's the best measure of a nation's standard of living. There are all sorts of problems with GDP per capita. It's not perfect. It's an average, so it doesn't take into account inequality like the Gini coefficient did. But based on the tools we have, it's a really good overall measure of a nation's standard of living. If you have a higher GDP per capita, that's going to correlate with more education, more healthcare, lower child mortality, et cetera, et cetera. So that's kind of the best measure we have. In the US right now, it's about $65,000 per person per year as our GDP per capita. Okay. These are just the most populated countries in the world. So China has the largest population, but they don't have the highest GDP because their GDP per capita is lower. These are the countries with the highest GDP per capita in the world as of 2017. Luxembourg, Switzerland, Macau, and China, Norway, Iceland are up there near the top. The US is about 7th So in terms of major, massive countries, we have the highest GDP per capita in the world. So what is going to determine which countries have a higher GDP? This is a super complex issue. This is like the study of development economics. It's a little bit messy, but there's some basic things that we can show that are going to increase productivity of an economy and therefore increase GDP and GDP per capita. The economic system is one point. So in general, capitalist countries have had a lot more economic growth than command economy countries, there's a lot of debate about how much you regulate that capitalism. But free markets, when they're allowed to work well, are going to create the most growth. Property rights are super, super important. If there's protected property rights in a country, people are going to have an incentive to save money because they know they're going to be able to have that advantage in the future. So not only save money, but earn money and invest in their lives, because they don't have to worry about a mob, a gang, or the government taking away their private property rights. And then the existence of capital is really, really important for economic productivity and higher GDP. So the capital stock in a country is the physical capital, and it's going to include the machinery, tools, and man-made resources that are used in the production process. And just to compare two countries, so India has a relatively low capital stock, and the US has really, really high capital stock. Okay. And Japan is also a country with a high capital stock. So even though Japan doesn't have that many natural resources, they have a lot of physical capital, and that contributes to them being the third largest economy in the world. Okay. And then not only is physical capital important, but so is human capital. And as you already know, human capital is that skills and experience inside of humans that makes their labor more valuable. And that's why education investment is so important for economic growth. Okay. And then finally, natural resources are important. So more productive natural resources can help with GDP growth, but it's not a guarantee. If you don't have the right system set up in terms of free markets and property rights, then sometimes you can end up having something called the resource curse, which is where a country is cursed by the resources. So if you look at like petrostates like Russia, one of the things that prevents them from investing in education and diversifying the economy is they have so much natural gas and oil that it allows them to depend on that resource, and it kind of prevents them from developing in other ways. But anyway, those are some basic items that contribute to productivity and GDP growth. Okay, so we're to talk in more detail about what is in GDP, but let's clarify what's not in GDP. So when we're looking at the GDP of a country, we're not going to include intermediate goods. Intermediate goods are goods inside final goods. So we would include the price of a finished car in GDP, but not the stock radio or tires in that car. So if when you're going off to college next year, your mom buys you a new Toyota truck, that's going to go towards GDP. The stock radio in it is an intermediate good. It's built into the price of that truck, so it's not going to go in. On the other hand, if you drive it down the street to Best Buy and you buy an aftermarket radio as a new product, that's a finished product that you're buying on its own, then it would count towards GDP. Non-production transactions are not going towards GDP. So financial transactions for which there's nothing produced are not going to contribute towards GDP. So when folks in a society buy or sell stocks, bonds, or real estate, it does not count towards GDP. Okay. Now, if you're a real estate broker and you are selling the service of buying a home for your client, then that service that you're providing is going to go towards GDP, but not the value of the real estate itself. So financial transactions do not count. We don't care who owns something. We care about what's produced, right? That's the value there. And then used goods don't count towards GDP. So an old car, used clothes, they're not going to count towards GDP. When they were new, they counted in that year's GDP. So we don't want to count them again in the year that they're repurchased. And then finally, non-market and illegal activities don't count. So things that are made at home, like household production, are not counting towards GDP. Anytime you do unpaid work, it's not going towards GDP. And then black markets, drug dealers, none of that's going to go towards GDP. And that could be significant. So in the US, just to give you comparison, it's estimated that about 8% of the economy, at 8% of activity is non-market and illegal activities, okay? And it's even higher in other countries. So that's what's not counted in GDP. If that's a tricky list for you, Krugman has this mnemonic device, if you, as a way of remembering all the different items that are not in GDP. Okay, so we know what GDP is, we know what's not included in it, so let's get to what actually is GDP. How do we actually calculate GDP? How do we get to that number of $20 trillion for the US economy? Well, there are three approaches. The first approach is the expenditures approach. Expenditures just means spending. And for the expenditures approach, you add up all the spending on final goods and services produced in a given year. The income approach is you add up all the income earned from selling all those final goods and services produced in a given year. And then the third and final approach is the value added approach, where you add up the dollar value added at each stage of the production process. Here's the key idea from this slide. In theory, all three of these methods should generate the same number. Okay, so if you added up all the spending that consumers and businesses and governments did on the US, it would equal all the income earned by the people who own the resources that produce those goods and services. And then similarly, if you added all the value added, so when the farmer took the wheat out of the ground, she added some value and then sold it to the baker who added some value and then sold it to Safeway who added some value. Okay, and if you added all those up, in theory, those are going to give you the same number. Of those three methods, by far the most important that we're going to use all semester long is the expenditures approach. When we're calculating the expenditures approach, there are four components that we're going to add together. Consumer spending is the first one, and consumer spending or consumption is a huge portion of our GDP. So in the US, consumption is about 70% of our GDP, and it's the purchases of final goods by private individuals. So if you go to Subway after school, and you buy a $5 sandwich, that's going towards consumption within our GDP. The second category is investment. Investment is about 15% of US GDP, and that is businesses spending on tools and equipment. Okay? When Walmart buys self-checkout machines, that is investment spending. They're buying capital goods to contribute to their business, and that is investment spending. The third category is government spending. In the US, that hovers around 20% of US GDP. And that is when the government purchases goods and services, when the government spends on education, when the government spends on military equipment like tanks, that's going to count towards GDP. Transfer payments are not. So transfer payments are when the government pays people for a social good, but for no good or service in exchange. So Social Security, food stamps, unemployment insurance, those are transfer payments. So they're not going to count. It's only when the government actually buys goods and services. Okay. Now, some of you may be looking at this and say, wait a second, something's wrong here. That adds up to more than 100%. And that's because in the US, it does because of net exports. So the fourth category of the expenditures approach to GDP are net exports, which is exports minus imports. So what if the US exports, say, for example, 3 Ford Focuses and we import 2 Hondas from Japan, you would take the dollar value of those exports and subtract the imports to get net exports, which is a negative number in the US because we import more than we export. Add it all together and you get the most important equation in macroeconomics. So this is the most important equation. This is the MR equals MC of macroeconomics. So GDP equals C plus I plus G plus XN. Okay, and this is actually super, super important. And if you can keep a secret, I'll tell you one reason how you know this is so important in macro. Okay, so that's Ben Bernanke, the former chair of the Federal Reserve. That's Janet Yellen. She's the current Treasury Secretary of the United States. So 2 great economists. And then, of course, me up there with them on the Pantheon. All 3 of us have something in common. on our left shoulders, in Old English, we have this equation tattooed on our arms. GDP equals C plus I plus G plus XN. Okay, that's how important this is to macroeconomics, and that when you graduate with your degree in econ, you get that tattooed as part of your graduation ceremony. A little bit more breakdown of each category. So when we're looking at consumption, there's actually 3 subcategories of consumption when we look at households buying goods and services. Durable goods are goods that are intended to last 3 years or more. So washing machines, refrigerators, cars, that goes toward consumption. And then non-durable goods also goes towards consumption. So that's when you buy food or clothes or toilet paper, anything that is for the short term. And then services are also part of consumption. So when you pay your dentist for dental work, when you get your car repaired, when you hire a tutor so you can pass those AP exams, that's all going towards consumption. Investment is important, but remember, in econ, investment means something very specific. It has other meanings across the normal sort of nomenclature, but for us, it never means buying stocks and bonds. Investment always means businesses buying capital, like machines, tools, and factories. Okay, and sometimes this can be a little bit tricky. So let's do a little practice question. Does the purchase of a new oven in America count as consumption or investment? Where the answer is, it depends. Okay, it depends on who's buying it. If the oven is purchased for the use in a home, then that would be consumption by a household. But if that oven is purchased by a business to make pizzas to sell to customers, then it would count as investment. So which subcategory it goes into is really a function of how that particular item is used. Okay. Couple other tricky questions related to consumption versus investment. So what about real estate? Okay. If there's a new home, produced, new real estate counts as investment spending since a new home can potentially be rented out. So if there's a new home built, it doesn't count as consumption, it's actually counted as investment. Okay. What about if a business produces something in 1 year but doesn't sell it to the next year? Okay. That's called inventory growth. So inventories are goods produced and held in storage, anticipated in anticipation of later sales. So inventories are actually counted in the year they're produced, not the year they're sold. The change in inventories is a valuable economic indicator. So if a company produces something in this year and increases their inventory, that's actually counted as investment because they're investing in future earnings. So that one can be a little tricky for students as well. And we really look at business inventories as a big economic indicator. This is a little tangent here because it correlates really, really well with recession. So you can see here that in 2008, 2009, the last Great Recession, and during downturns like that, when business inventories drop, that's oftentimes a leading indicator that the whole economy is in trouble. Let's talk a little bit more about government. So government expenditures track the spending made by the public sector. So like I said, that includes payments for goods and services, like the price of fighter jets or the salaries of pilots. It doesn't include welfare, Social Security, or subsidies that the government pays. It doesn't include interest paid on the national debt. Okay, and like I said on that other slide, in the U.S., generally speaking, the U.S. We hover around that 20% mark for percentage of GDP. Big exception to that was, of course, in the 1940s. So think historically, why did that jump up so big in the 1940s? Because of World War II, right? So the government was spending like crazy in World War II, which made our percentage of government spending for GDP jump up to like 50%. Alrighty, so those are all the categories. Let's put this into practice. This is a really important slide so you can make sure you see if you're getting it. What you have here are 10 different items, and what you need to do is pause this video and determine, is this counted in US GDP, yes or no? And then if it is counted in US GDP, you need to figure out, is it part of consumption, investment, or net exports? Okay, make sure you subtract out imports as part of net exports, and then sum up your number, right? So not only do I want you to tell me what's included and what's not, but I want you to give me the actual GDP. So based on the slide, what is the total sum of GDP? Good luck. Pause the video and give it a try. Okay, here we go. Drum roll, please. Let's see who got the correct number. This GDP of this slide is $7,125,010. Movie tickets are consumption. Defense expenditures are government spending. Used textbooks do not count. Building a new factory is investment. Toyotas that are made and sold in Mexico have nothing to do with US GDP, so that doesn't count. Profit from selling stocks does not count because that's a non-production transaction or a financial transaction, doesn't count. $15,000 car made in the US, sold in Canada is an export, so that goes towards US GDP. Tuition to attend college is consumption. You're paying for the service of an education. A lot of students get tricked up on that one and say, well, wait a minute, I'm investing in my future. Remember, in this class, investment only means businesses spending on tools, factories, and machinery. So that's consumption. Social Security is a transfer payment, doesn't count. And then buying a new tractor, if you're a farmer, is investment spending. So that's how you use the expenditure approach. We're going to do that over and over and over in different ways in this course. Okay. Let's talk a little bit more in detail about the income approach. So the income approach adds up all the income earned from producing goods and services. So there are 4 subcategories of GDP for the income approach. The first one is labor income. So when you go and you buy that $5 sandwich at Subway, that's contributing towards the wage of the people who are working there. Rental income is income earned from property owned by individuals. Interest income is interest earned by folks who loan money to businesses, and then profit is money made by businesses after paying all their costs. So all these are the 4 types of factor payments for the people who own the factors of production, right? So there are 4 factors of production. So there are 4 types of income that can be earned in an economy, okay? So if you add up, so you guys know the 4 factors of production: land, labor, capital, entrepreneurship. So the income earned off of labor is wages. The income earned off of land is rent. The income earned from capital is interest. And the income earned from entrepreneurship is profit. So if you add up all 4 of those things, you're going to get the same number. So you could add up all 4 types of income in the US and you would get $20 trillion. And if you add up all the 4 subcategories of expenditure for consumption, you get $20 trillion as well. Pretty cool. Pause the video, read this political cartoon, and what I want you to think about is some criticisms of what GDP doesn't do well. So as you can see here, GDP is not perfect, right? If you spend money on a divorce, that's going towards GDP, but that's arguably not making society better off, right? So there's some really helpful, important criticisms to consider for this indicator. It's certainly not perfect, but it's a great way of getting everyone on the same page, okay? Before we go on to nominal and real GDP, I want you to pause the video, stand up, stretch, take a 2-minute break, and then come on back so you're ready to learn more. Let's talk about nominal versus real GDP. So a little fun question for you. If we were going to try to figure out the most popular movie of all time, I want you to brainstorm what are different strategies we could use to do that, okay? So oftentimes students say, hey, let's figure out what the box office income was of those movies, okay? And if we did that, we would see that Avatar, Titanic, and Star Wars: The Force Awakens are the top films as of 2019. Okay? And that's just looking at nominal box office receipts. What's the problem with doing that? This is going to bias more recent movies because it's more expensive to go to a movie today than it was 20 years ago or 50 years ago. Okay, so if we adjust for inflation, then we can look at more popular movies a little bit more objectively, right? And if we do that, we look at real box office receipts, real is adjusted for inflation, then we can see that Gone with the Wind is going to be number one, because in 2017 dollars, the value of those box office receipts is actually higher than Avatar. Okay, so that introduces the idea of real versus new GDP. Okay, let's think about this in a couple of other ways. What if I told you the GDP of one country increased from 4 billion to 5 billion in 1 year? Is that country experiencing growth? Well, did they definitely have 25% more products? Not necessarily, right? One of the things that could have happened is inflation. Inflation is just a general rise of prices. This naturally happens all the time, but it doesn't necessarily tell us if life is getting better if all that's happened is inflation. Okay, so let's look at an example here, a simplified example. If we're looking at a country and the only thing being produced in that country are apples, and in year one we had 10 apples at $1 each, then our GDP for that country would be 10 bucks. Okay, and then in year two we also had 10 apples produced, but the price level went up. I'll teach you why that might happen later, but let's just imagine now each of those dollars is $1.25. So the total GDP in that country is 1250. So even though GDP rose, arguably the country is worse off, because if your wage hasn't changed, your standard of living is lower and you can buy fewer apples for your family each um, each year. Okay, so we need to adjust for inflation, and that's something called real GDP. So nominal GDP is measured in current prices. It does not account for inflation from year to year. So you simply add up all the goods and all the C plus I plus G plus XN, and you use whatever the current prices of those things are, and you got GDP. Real GDP is going to adjust for inflation. And the way that that works is you express it in constant or unchanging dollars. Okay, so you express real GDP in constant dollars. And when we're looking at ways to measure real economic growth, we want to use real GDP, because we can say, is there actually more for society to consume? And our incomes actually higher when we look at the income approach, uh, taking out the issue of price changes. So this is an important slide because I'm going to show you how we actually calculate this. In 2008, I want you to imagine a fake economy where all that's produced are cars and trucks. And these are the different prices of cars and trucks. And if we added up 10 cars at 15K and 10 trucks at 20K, we would get a nominal GDP in 2008 of $350,000. So far, so good. Okay, that's the GDP in year 2008, and it's the dollar value of all final goods and services produced. Okay, so far, so good. Now, let's look at 2009. In that same economy, 1 year later, we had 10 cars produced at $16,000 and 10 trucks produced at $21,000. So now if you add up the nominal GDP, you're going to get $370,000. So if you look at just nominal GDP, you can see that nominal GDP is higher, and that's going to suggest the economy is improving. But what about real GDP? How would we get it? To get 2009's real GDP, we would take the output from 2009, so the current output in terms of these quantities, but we would use 2008 prices. So we go to what's called the base year, we go to the old prices, and we plug them in to the new production for 2010, and that's how you get real GDP. You use 2008 prices. So you can see when we take out the price change issue, real GDP in 2009 is $350,000. So it's the same once we adjust it for inflation. So that's going to tell us, all right, the quality of life is the same for people in the society, but not necessarily any better. Okay, so that's the concept of real GDP. And what real GDP does is it deflates nominal GDP. So this blue line here, we're looking at a timeline of the US in about the last 20 years, and we're looking at GDP. And you can see that GDP, if we look at nominal GDP, it went from about $6,000 to call it about $19,000. So it looks like real GDP tripled. Okay, but if we adjust for inflation and use base year prices, you can see that real GDP here kind of flattens out, and it goes from say about 9,000 to about 17,000. So in terms of real GDP in this 20-year period, life got better, right? But it got twice as good, not 3 times as good, once we take into account real GDP and take out inflation. All right, last concept on here, super, super important, and that is the business cycle, ladies and gentlemen. And the key metaphor for the business cycle in economics is a roller coaster, because the economy goes up, but eventually what goes up must come down, and that is the business cycle. So when we draw out the business cycle, we're going to put real GDP on the vertical, and we're going to put time on the horizontal. And what we're going to see is that the national economy goes up and down like a roller coaster over time. This model is going to be a simplified model of what's much messier and harder to predict in the real world, but it helps us understand GDP growth over time. So the business cycle shows real GDP going up and down and up and down. There are peaks, there are troughs. Okay. When our real GDP is falling from a peak to a trough, that is a recession, right? So in 2020 and 2021, the US economy is in a recession because of the COVID crisis. So we're coming down from a peak towards a trough. Another word for a recession is a contraction in the economy. And then as we come up from the trough to another peak, that is known as a recovery, also known as an expansion. So the US economy was expanding coming out of the Great Recession in 2008, 2009. So all throughout the 2010s, we were experiencing a recovery and an expansion in real GDP. If you were to draw a trend line in the middle of that business cycle, you would get a potential GDP that's also known as full employment. Okay, and we'll talk a lot more about full employment next time. But this is the potential GDP, and that trend line is important because that's what, based on kind of the current situation, this is the capacity for growth in that economy. And sometimes we're going to go above it, sometimes we're going to go below it, but overall, this is kind of our potential GDP. And when the economy is overheated, you're going to be above your potential GDP and above your full employment output. And then when the economy is in recession, you're going to be below it. But ultimately, that's kind of the trend line growth that any economy can endure. Okay? When the economy is overheated and it's above its potential GDP and unemployment is lower than the full employment trend line, you're going to get lots of inflation in the economy. And the economy is going to be overheated and prices are going to go up. On the other hand, when you're below the trend line, you're going to have lots and lots and lots of unemployment, and you're going to have way more people out of work than you would want. Okay, and so you can see all the kind of major indicators that we're going to use in this unit. You can see them and use them to explain this business cycle graph. A lot of students ask at this point, well, what's a technical definition of a recession? We usually say that a recession is a 6-month period of decline in real GDP. And a really, really bad recession is a depression. Okay, and to kind of jump forward a little bit and to give you preview about what's going to happen in this class is one, once we get the fiscal and monetary policy, what modern governments try to do is not stop the business cycle, because if you're in a free market economy, you're going to have expansions and contractions. Okay, but what we try to do with fiscal and monetary policy is ride this out. So if we start overheating, the federal government will try to slow down that overheating, prevent too much inflation, and then make that so we are not as impacted negatively by that. And then when we come down to a recession, they try to flatten out that trough and make it so not as many people lose their jobs and we can recover sort of as quickly. So that's what we're going to try to do once we become policymakers later in the course. All right, folks, by now that we've done this lesson, you should be able to do these 9 things. Take a look at them, see if you can do them on your own verbally. And then if you have any questions when you come back to class, let me know if I can help with any of these things. Thanks for listening. Enjoy the rest of your day.